Before we begin, make sure to subscribe so you won't miss future journeys like this one. Welcome to Sleeponomics. Here, we tell calm and thoughtful stories from the world of business, finance, and innovation. Carefully researched, softly narrated, and designed to help you relax, reflect, or gently drift into sleep. Each story explores how the systems that shape our world came to be, from quiet inventions to global transformations. So, wherever you are, settle in. Let your body rest. Let your thoughts slow down. And let us take you on a journey, not of noise or headlines, but of structure, patience, and perspective. Tonight we begin with a black screen, just a flicker of green light. Not from a dream, but from a terminal. An old humming box filled with numbers, charts, and code. This machine would quietly transform how the world's markets move, how decisions are made, and how billions are earned or lost in silence. It's known simply as the Bloomberg terminal, and the man behind it was someone few had noticed, until he changed everything. Michael Bloomberg wasn't born into power. He wasn't a tech visionary or a Silicon Valley founder. He was a bond trader, a precise, stubborn man in a gray suit. And in 1981, he lost his job. He walked out of Salomon Brothers, one of Wall Street's most respected firms, with no plan, just a severance check and a head full of ideas. But from that exit came the beginning of a company that would reshape how markets work. Bloomberg LP. At that time, Wall Street was still mostly analog. Trading floors were busy and loud, filled with paper slips, phones, and human voices. Information came slowly. Prices changed, but few saw them in real time. For many traders, the delay between an event and its visibility could mean millions gained or lost. Michael Bloomberg saw an opening. What if you could compress time? What if you could bring together price data, economic news, company metrics, and communication, all in one place, in real time? That vision would become his life's work. It is fascinating to reflect on how often the most enduring transformations begin not with triumph, but with disappointment. Michael Bloomberg could have stepped away from finance altogether. After all, he had been forced out of a prestigious firm. He had no product, no team, and no guarantee of success. But what he did have was conviction, an unusually sharp instinct for how systems could work better. During his time at Salomon Brothers, he had developed a sensitivity to the way information moved, or failed to move. He noticed delays, duplication, and distortions that others ignored. Traders and analysts were making decisions based on outdated quotes and static reports. The opportunity, he realized, wasn't just to improve what people saw. It was to change when they saw it. In 1982, Bloomberg took the first real step toward that vision. With funding from Merrill Lynch and a few trusted collaborators, he founded a small venture called Innovative Market Systems. The idea was to build a real-time information machine for bond traders, one that offered up-to-the-minute pricing data, historical comparisons, economic indicators, and analytics all in one integrated interface. The first version was modest, but it had something other platforms lacked: clarity. Data was organized, searchable, and updated continuously. Users could compare prices, run custom analyses, and even model risk, all from a single glowing terminal. Traders quickly noticed the difference. What once took minutes or hours now took seconds. The machine didn't just report on the market, it became part of it. A tool not just for watching, but for acting. Within months, Merrill Lynch rolled out the terminals across more desks. Other firms took notice. Bloomberg renamed the company in his own name, and the Bloomberg terminal began its quiet rise from a curiosity to a necessity. The machine was not beautiful, it was not simple, but it worked, and in finance, functionality is everything. From that flickering screen, green text on a black background, a new financial language was forming. It would speak in live data, global feeds, algorithmic logic, and endless customization. And at the center of it all was a former trader who saw what others missed, that in a market built on speed, information is not just helpful, it is the infrastructure. Michael Bloomberg's path to reshaping global finance did not begin in a boardroom. It began in the back offices of Salomon Brothers in the 1960s, where he was assigned to the firm's data processing department. At the time, this was hardly considered glamorous. In fact, it was seen as a kind of exile for those without a clear role on the trading floor. But for Bloomberg, it was an ideal environment. The role forced him to learn the mechanics of financial information from the ground up. He didn't study balance sheets in theory. He managed how they were printed, sorted, and distributed. He didn't just observe market data. He learned how it flowed, where it stalled, and how errors multiplied over time. In these unglamorous details, he began to notice patterns. He understood something that would later define his company, that the delivery of information is just as important as the content itself. A slow quote is a useless quote. An unread report is no better than no report at all. Traders didn't need more information. They needed faster, more relevant, and more structured access to what already existed. Outside of work, Bloomberg cultivated a reputation for precision. He was rarely late. He dressed conservatively, kept detailed notes, and constantly pushed for better tools that often didn't exist yet. He didn't wait for others to fix problems. He wrote small software scripts to improve his own workflow, even before most of Wall Street took computing seriously. It's fascinating to reflect on how certain careers are shaped not by ambition alone, but by the constraints they begin within. Bloomberg did not start out wanting to be a media mogul or a billionaire technologist. He simply noticed inefficiencies and began solving them, one workflow at a time. As he rose through the ranks, Bloomberg transitioned from data operations to bond trading. This was where he truly learned how information translates into money. Bond markets rely heavily on timing, precision, and comparative metrics. Traders live and breathe in the margin between what something is worth and what someone else thinks it's worth. The faster you can process new data, the more precisely you can move. Bloomberg's approach was distinctive. He didn't trust rumors. He asked questions others ignored. He wrote down numbers obsessively. And he paid close attention to how small differences in access could shape massive differences in outcome. If one trader knew about a shift in interest rates 30 seconds before another, that sliver of time could be worth thousands. He also began noticing that much of the information traders relied on was already outdated by the time it hit their desks. Printed reports arrived hours or days after they were written. Even price quotes passed through multiple layers of delay. He began asking what many considered an irrelevant question at the time. What would happen if everyone had instant structured data? By the mid-1970s, he had become a general partner at Salomon Brothers. It was a lucrative role, but Bloomberg's mindset remained operational. He was less interested in salesmanship and more focused on tools. This tension would ultimately define the next chapter of his career. Because while his peers were competing for clients and bonuses, Bloomberg was quietly building a mental blueprint, one that would only become clear after he was forced out. It is calming to observe how certain people are quietly building something far larger than their current surroundings suggest. Bloomberg didn't speak in grand visions. He observed, he analyzed, he adjusted. And while others chased faster trades, he was imagining faster systems. And soon, the firm that had given him his chance would become the place that pushed him out, setting into motion one of the most unexpected entrepreneurial turns in Wall Street history. By the late 1970s, Salomon Brothers was one of the most prestigious investment banks in the world. Known for its aggressive trading culture, it dominated the bond market and cultivated a generation of powerful Wall Street figures. Michael Bloomberg had earned his place at the partner table, not through charm or politics, but through process. He had become the firm's go-to expert on internal systems, especially for pricing, analytics, and information flow. He wasn't flashy, but he was essential. Then, in 1981, everything changed. Salomon Brothers was acquired by a commodity trading firm called Fibro Corporation. The merger was not just financial, it was cultural. The new leadership valued different traits. They favored raw trading instincts over operational finesse. And in the reshuffling of roles and priorities, some senior partners were seen as non-essential. Bloomberg was among them. At age 39, with over a decade of service behind him, Michael Bloomberg was let go. He didn't expect it. Few did. But the decision was final. He received a severance payout of $10 million, a substantial amount, but not a consolation. For a man who had built his identity inside Salomon's walls, the dismissal cut deeper than the number on the check. What followed was a moment of rare stillness. Bloomberg no longer had a title. He no longer had a desk. But what he did have was an unusually clear sense of how financial systems worked, and more importantly, how they didn't. He began spending long hours sketching out concepts, not pitches or business plans, but functional ideas. He listed out what traders needed, how they accessed data, where friction occurred, and what kinds of tools could eliminate it. He wasn't trying to build a terminal just yet. He was trying to solve a pattern he had seen for years. That information in finance flowed through too many pipes, too many hands, and too slowly. The firing, in retrospect, was catalytic. It stripped away hierarchy and forced clarity. And in the absence of direction from others, Bloomberg began creating his own. It is compelling to consider how many entrepreneurial stories begin not with vision, but with vacancy. Bloomberg did not set out to disrupt anything. He simply had time to think, to sketch, and to follow a thread he had ignored while employed. With no clients to answer to and no colleagues to appease, he returned to his roots, systems thinking. He reached out to 3 colleagues he trusted from Salomon. Each brought a unique skill, technical knowledge, financial acumen, or software logic. Together, they began working on what they initially called the Market Master Terminal. The goal was modest: provide bond traders with faster, cleaner access to pricing data and analytics. They pitched the concept to Merrill Lynch. The timing was fortuitous. Merrill was looking for ways to modernize its fixed income desks and was open to experimental tools. Bloomberg made a proposition. If Merrill would fund the development, they would receive a customized terminal and a stake in the venture. The offer was accepted. With that deal, Bloomberg LP was born, though at the time it was still known as Innovative Market Systems. In rented office space, the small team began building. They didn't follow typical startup models. There were no marketing campaigns, no venture capital rounds, no public buzz. Just quiet development, daily iteration, and an obsessive focus on usability. The earliest version of the terminal looked nothing like the sleek devices of today. It was a bulky setup, running on primitive displays with text-heavy menus. But beneath the rough interface was something new: real-time integration. Data, once delayed and disconnected, now flowed live. For the first time, a bond trader could see, on one screen, the current market price of a security, historical price charts, interest rate movements, and relevant economic news, all updated continuously, all available without switching systems. What had begun as a response to a firing was now beginning to resemble something else entirely. A new platform for how financial professionals engage with the world. And quietly, one terminal at a time, the foundation for a future information empire was being laid. The birth of Bloomberg LP in 1982 was quiet by design. There was no press release, no market hype, just four men in a small rented office in Manhattan, armed with a concept, a cash infusion from Merrill Lynch, and a belief that real-time information could change how markets behave. Michael Bloomberg brought something to this new venture that most founders in financial tech lacked: deep insider knowledge. He had spent over a decade not just working on Wall Street, but understanding its machinery. He knew the tempo of trading floors, the quirks of sales desks, the decision patterns of portfolio managers, and crucially, he knew their pain points. The startup, still known at this point as Innovative Market Systems, began building what would become the prototype Bloomberg terminal. The early version was crude. The software interface was purely text-based, built for function rather than form. It was a command line tool that required users to input precise codes to navigate between data streams. But within that rough shell lived something revolutionary: integration. The terminal was built to be responsive. Traders could search live bond prices, historical trends, yield curves, and related economic news in a single flow. If a user typed in the identifier for a bond, they would immediately see not just the current price, but also relevant analytics, maturity, duration, risk metrics, and comparative instruments. Behind the scenes, the system was powered by proprietary software designed to scrape, organize, and continuously update financial data from multiple feeds. But more importantly, it stored those relationships in a structured way. Bloomberg wasn't just showing data, he was contextualizing it. It is fascinating to consider how radical this was in 1982. Most financial data systems at the time were still siloed. A trader might have to look at one terminal for prices, another for news, and still another for analytics. Bloomberg brought them together, not through hardware innovation, but through smart data architecture. The early product was not sold. It was placed exclusively with Merrill Lynch, which now owned a 30% stake in the company. Merrill used it internally and gave critical feedback. Bloomberg and his team responded with rapid iteration. Every complaint became a fix. Every suggestion became a feature. The goal was never to impress, it was to embed. From the beginning, Bloomberg understood something most software founders underestimated: that in finance, relationships matter more than advertisements. Rather than hiring sales teams, he used his Rolodex. He called former colleagues. He met people for coffee. He walked into offices unannounced, demo terminal under his arm. He didn't pitch the machine. He asked questions. What slows you down? What data do you wish you had 10 minutes sooner? What do you do when the quote screen freezes? In those conversations, Bloomberg wasn't just selling a product. He was building one. The terminal began to evolve rapidly. New modules were added: corporate financials, equity pricing, government data. Bloomberg insisted that every feature be functional, not ornamental. He famously rejected the idea of adding color to the interface, arguing that clarity and speed should always come first. A delay of even half a second was unacceptable. Over time, the team grew. Engineers joined, data specialists arrived. But the culture remained tight, focused, and intensely practical. Meetings were short. Development cycles were measured in days, not months. Every user request was logged, tracked, and responded to. And behind it all was Bloomberg himself, sharp, tireless, and deeply involved. By 1984, the company had placed several dozen terminals. Merrill remained the cornerstone client, but word was beginning to spread. Traders from other firms began requesting access. Bloomberg faced a decision: remain a boutique tool for a single institution, or open up to the market. He chose scale, but scaling required more than code. It required infrastructure, service, and above all, capital. Bloomberg reinvested most of the company's early revenue into growth. They expanded their server capacity. They built out 24-hour technical support. They created training programs, installation teams, and client onboarding systems. Every terminal placement became a mini operation. The team arrived in person, set up the hardware, walked through features, and returned to collect feedback. There were no shortcuts. Each client relationship was treated as irreplaceable. This approach proved invaluable. In an industry where trust is scarce and stakes are high, Bloomberg's obsessive service culture began to stand out. Not because it was flashy, but because it was consistent. The foundation was now in place: code, contacts, capital. And with each new installation, the system grew stronger, not only in size, but in indispensability. The machine was still quiet, still mostly black and green, but inside it, something powerful was happening. A network was forming, and once enough desks were connected, a new kind of market infrastructure would emerge, one that didn't just display the news, but helped shape it. By the mid-1980s, the Bloomberg terminal had begun its quiet takeover of modern finance. It wasn't disruptive in the way that technology is often described today. It didn't crash existing systems or make headlines. It simply made itself indispensable, desk by desk, decision by decision. The financial world was already complex, but Bloomberg made it navigable. Before the terminal, a trader had to juggle multiple sources, printed reports, live phone calls, scattered databases. Some relied on proprietary systems patched together over years. Others depended on institutional memory and habit. But none had a tool that brought everything into one frame. Bloomberg's system changed that. What made the terminal revolutionary was not just the speed of information, but the architecture of access. Bloomberg structured the system around function codes, short commands that pulled up precise data sets. If a user wanted a price chart, they typed one code. If they needed historical earnings for a company, another. Everything was linked, and every layer updated in real time. At first glance, it looked like code, but to its users, it became language. And within this language, something new emerged: financial fluency. The terminal allowed professionals to move effortlessly from one layer of information to another, from a bond's yield curve to its issuer's dividend policy, from macroeconomic trends to micro-level analytics, from sector-level sentiment to individual security valuations. What had once required time, coordination, and translation now took seconds. Bloomberg didn't just accelerate decision-making, he compressed entire workflows. It's fascinating to reflect on how this changed behavior. Traders began building routines around their terminals. Portfolio managers checked them first thing each morning. Analysts crafted models using terminal exports. And most importantly, collaboration began to shift, from internal team discussions to real-time chats across institutions. That's when Bloomberg introduced what would become a cornerstone feature: instant messaging. It seemed like a minor addition at first, but in an industry where trust is limited and timing is critical, the ability to speak securely and instantly with peers across the network changed everything. Negotiations began to happen over terminal chat. Trade ideas were vetted, confirmed, and executed, all without picking up a phone. The terminal had become more than a source of information. It was now a platform for coordination, and that changed its role in the financial ecosystem. Every new terminal made the system more valuable. Every user made the network more necessary. This was no longer a product, it was infrastructure. By the late 1980s, Bloomberg's footprint had expanded far beyond its origin in fixed income. The terminal now covered equities, currencies, commodities, government data, derivatives, and a growing library of corporate information. Financial professionals across the world, London, Tokyo, Frankfurt, Sao Paulo, were logging into the same network, speaking the same code, seeing the same numbers at the same time. This level of information symmetry had never existed before, and with it came a subtle but profound shift in power, from individual intuition to systematized insight, from gut-based speculation to data-based conviction. Bloomberg had not changed the nature of finance, but he had changed how it was practiced. The terminals themselves were still not elegant, still green text on black screens, but their presence in a room said something. They represented seriousness, access, and fluency in a new kind of financial literacy. To use a Bloomberg terminal was not just to consume information, it was to enter a kind of professional rhythm, one defined by clarity, continuity, and quiet intensity. And that rhythm was spreading. By the turn of the decade, something subtle but powerful was beginning to take hold. The Bloomberg terminal was no longer just a device. It had become a medium. And as more desks, firms, and institutions adopted it, a rare economic dynamic began to emerge, one that would solidify Bloomberg's dominance for decades to come. This was the network effect. In basic terms, a network effect occurs when the value of a service increases as more people use it. Telephones follow this logic. 1 is useless. 2 enable a conversation. 1,000,000 make a system. Social media, too, grows not by adding features, but by adding connections. Bloomberg achieved this, quietly, inside the financial system. But the stakes were far higher. Every terminal added to a trading desk meant one more link in a closed, trusted network of professionals. The instant messaging feature, known informally as Bloomberg Chat, became a kind of private internet for finance. Traders negotiated directly. Analysts compared views. Salespeople shared color from other clients. And all of it happened inside the terminal, never outside. It is important to pause here, because this level of integration had never existed in finance before. Banks and funds had their own systems, their own phones, their own platforms. Communication across firms was rare and fragmented. Bloomberg changed that, not by forcing it, but by making it useful. The more people had the terminal, the more valuable it became, not only because of the data it provided, but because of who else was using it. This effect went beyond chat. Portfolio managers used Bloomberg's functions to send allocations to traders. Risk teams used it to monitor real-time exposures across geographies. Journalists began quoting Bloomberg screens in headlines. Even central banks began referencing Bloomberg prices in internal reports. And as adoption grew, the network began feeding itself. It is fascinating to reflect on how influence can become invisible when it is fully embedded. Bloomberg did not promote itself as a monopoly. There were competitors. Reuters had strong positions in foreign exchange and news. Dow Jones still dominated in equity reporting. But Bloomberg didn't have to dominate in every vertical. It simply had to become the default interface. And slowly, that is exactly what happened. A junior analyst using the terminal at one firm would take that knowledge to their next job. A trader who relied on Bloomberg's pricing functions would request it again at their new desk. In this way, institutional familiarity became personal fluency, and personal fluency became corporate dependency. Firms began writing Bloomberg functionality into their operating procedures. Terminal commands became part of training manuals. Internal reporting tools were linked directly to Bloomberg data exports, and soon, entire workflows were built on top of it, some visible, many invisible. One of Bloomberg's strategic insights was to support this organically. The company provided not only the terminals, but the infrastructure to help clients build around them. Application programming interfaces, APIs, were offered for firms to pipe Bloomberg data into their own models. Historical data libraries were made searchable. Custom templates were developed for specific use cases, from risk analysis to portfolio optimization. In return, Bloomberg gained something invaluable: structural lock-in. Removing the terminal was no longer a decision about cost. It became a question of risk, because removing it now meant changing systems, retraining teams, rewriting workflows, and losing the network that so many relied on to operate in real time. Bloomberg never made the terminal feel like a sales product. It felt like a utility, like electricity or water, rarely noticed when it worked, but painfully absent when removed. This level of integration created not only stability, but scalability. The firm could now expand horizontally, offering new features to an already captive user base. Bloomberg Law, Bloomberg Government, Bloomberg ESG, data, all were layers built on the foundation of the terminal, each one adding relevance to a new segment while deepening reliance among existing users. And all of this happened without fanfare. There were no splashy ad campaigns, no celebrity endorsements, just screens, glowing, consistent, fast, expanding their quiet presence across global finance. By the early 1990s, Bloomberg had reached a tipping point. The terminal was no longer a choice, it was a requirement. And the network it had built, user by user, screen by screen, was now its moat. It is calming to realize that sometimes true dominance is not loud. It does not announce itself. It does not seek attention. It simply works, quietly, relentlessly, and everywhere. By the early 1990s, Bloomberg had done something remarkable. It had built a financial technology product that didn't just succeed, it became essential. But Michael Bloomberg was not finished. He understood something that would soon redefine his business. In the modern economy, information is not just data, it is narrative. And narrative shapes perception, behavior, and ultimately, markets. That insight led Bloomberg into a new arena, media. At first glance, this seemed like a departure. Why would a company built on terminals and data streams enter the world of headlines and broadcasts? But for Bloomberg, the logic was clear. The same professionals who relied on his platform to analyze financial data also needed trusted news, fast, accurate, and, ideally, embedded directly into their workflow. In 1990, Bloomberg launched Bloomberg News. It began modestly. A small team of journalists focused on market-relevant developments. But the model was different from traditional media outlets. Bloomberg's reporters were not writing for general audiences. They were writing for the screens, those glowing terminals where traders watched prices move tick by tick. This made the tone of Bloomberg News unique. It was sharp, data-centric, and relentlessly timely. Headlines were short. Lead paragraphs delivered facts, not flourishes. Analysis came second to speed. In an environment where a single headline could move a market, Bloomberg wanted to be first and accurate. And the stories did not live in newspapers. They appeared directly in the terminal feed. It is fascinating to reflect on how elegant this strategy was. While other media companies chased circulation or ad revenue, Bloomberg News was embedded. It lived inside a product that clients already paid for. There were no barriers, no paywalls, just one more function code, type TOP, and the latest financial headlines would appear. Bloomberg was not just reporting on markets, it was informing them in real time. Soon after, Bloomberg expanded into broadcast. In 1993, the company launched Bloomberg Radio, followed by Bloomberg Television in 1994. These two followed a distinct formula. No hype, no punditry, no drama. Just round-the-clock business news, spoken clearly, with charts on screen and minimal interruption. The tone matched the terminal. Professional, focused, data first. These media layers had two purposes. First, they extended Bloomberg's brand of factual precision into new spaces: car radios, office lobbies, home televisions. But second, and more strategically, they protected the core business. The more professionals got used to Bloomberg's view of the world, the more they relied on its platform. Familiarity became fluency. Fluency became preference. Bloomberg never tried to entertain. It aimed to inform, faster and with fewer assumptions. And over time, this created a media identity unlike any other. Bloomberg content was not designed to win awards or produce viral moments. It was designed to serve the moment, the exact minute a trader, regulator, or economist needed it. That minute mattered, because in markets, timing is currency. By the late 1990s, Bloomberg had built an unusual fusion, a technology company that was also a newsroom, and a newsroom that existed inside a terminal. Very few firms had that blend of infrastructure and editorial, and even fewer used it not to sell ads, but to sell access. Bloomberg didn't monetize its media through commercial breaks. It monetized by making the terminal even more essential. If clients trusted Bloomberg News, they were less likely to open another window, less likely to subscribe elsewhere, and more likely to keep renewing their licenses at thousands of dollars per user per year. This was vertical integration of a different kind, not owning supply chains, but owning context. Bloomberg controlled the data. Then it controlled the story around the data. And finally, it controlled the interface where both appeared, together. What began as a terminal now had voice, image, and reach. It is calming to observe how some empires grow not by force, but by coherence. Bloomberg did not spread itself thin. It added only what deepened the experience. News, audio, video, all served the same purpose: to keep the user inside the world Bloomberg had built. And once inside, there was little reason to leave. From the outside, Bloomberg LP looked like a media tech hybrid, equal parts data network, software platform, and information provider. But inside, it operated more like a machine, not chaotic, not cold, but precise, disciplined, and above all, controlled. At the center of this control was Michael Bloomberg himself. Unlike many tech founders who stepped away as their companies scaled, Bloomberg remained deeply involved in daily operations. He walked the floors. He asked pointed questions. He read usage reports. And he managed the company not like a CEO with distance, but like an engineer inspecting a system for friction. The internal culture he built was rooted in accountability. Employees were expected to know their metrics. Teams were structured around product functions rather than hierarchies. Every project had to justify itself through use. If a feature wasn't being used, it was either improved or removed. And there was little tolerance for inefficiency. It is interesting to consider how this culture emerged. Bloomberg had never been a manager in the traditional sense. His style was direct, unsentimental, and execution-focused. But he understood something many leaders overlooked. That culture is not what a company claims, it is what it enforces. At Bloomberg, the values were speed, clarity, and responsibility. That translated into behaviors. Meetings were short, status reports were concise. Emails were often replaced with internal notes typed directly into the terminal. Employees were encouraged to fix problems before escalating them. There were no corner offices. Desks were open. And Bloomberg himself often sat in the middle, visible, present, and active. This style was not universally popular. Some found it intense, others found it refreshing, but over time, it created consistency. Turnover was relatively low, loyalty was high, and decisions, once made, were implemented quickly. The physical environment of Bloomberg's headquarters reflected this same ethic. Floors were open, brightly lit, and transparent. Glass walls replaced private doors. Data screens were visible from every angle. Visitors often described the space as more like a trading floor than a tech campus. This was intentional. Bloomberg wanted the office to feel alive with information. Every decision, design, layout, lighting, was made with purpose. Even the company pantry offered healthy food, restocked daily, free of charge. Not as a perk, but as part of a system. The goal was simple: eliminate friction, increase focus, and keep people thinking. Internally, performance was measured constantly. Not just sales, but usage. Engineers received feedback not only from managers, but from user data. How many times was a feature used last week? What commands were trending? What screen layouts were preferred in Tokyo versus Frankfurt? This data wasn't used to punish, it was used to refine. And at the center of this refinement process was a simple principle: control the inputs, and you improve the outputs. Bloomberg believed that good decisions came from good systems, and good systems came from consistent discipline. That discipline extended to how the company handled customer relationships. Clients were not segmented by tier or size. Every user had access to support, training, and technical assistance. Installations were done manually. Feedback was logged precisely. And account renewals were handled through trusted relationship managers, not call centers. This customer model cost more, but it delivered loyalty. It is calming to reflect on how quiet professionalism can outperform louder growth strategies. Bloomberg never promised to change the world. It simply promised to make your work faster, clearer, and better. And then it delivered, relentlessly. As the company expanded globally, the culture traveled with it. New offices in London, Hong Kong, and São Paulo followed the same model. Same desks, same layout, same expectations. Even the terminal interface remained consistent across time zones and regions. A trader in Singapore could message an analyst in New York without delay or translation. The platform worked the same way for everyone, because the culture behind it insisted on uniformity. Over time, this culture became self-sustaining. New hires learned not just the software, but the ethos. Solve problems, share credit, stay fast. And behind it all, even decades in, was Michael Bloomberg, still walking the floor, still monitoring the data, still insisting that every detail, no matter how small, added up to something bigger. Control at Bloomberg was not about restriction. It was about precision, a belief that when every part of a system works smoothly, trust is built. And from trust, everything else follows. In 2001, Bloomberg LP was thriving. The terminal had become the backbone of modern finance. The media division was expanding steadily. The company was private, profitable, and remarkably stable. But that same year, Michael Bloomberg made a decision few expected. He stepped away from his role as CEO to run for public office. At the age of 59, Bloomberg launched a campaign to become mayor of New York City. On the surface, this pivot from executive to politician seemed abrupt, but in many ways, it was a natural extension of his philosophy. Bloomberg believed in systems. He believed that data could drive smarter decisions. And he believed that institutions, if managed with discipline, could improve lives. New York, still reeling from the attacks of September 11th, was facing a moment of crisis. The city's finances were fragile. Trust in leadership was shaken. Bloomberg, a lifelong technocrat, presented himself as a calm, competent alternative. He ran as a Republican, despite previously identifying as a Democrat, not for ideology, but for strategy. He knew the Democratic field was crowded, and that the Republican line gave him a clearer path. He funded the campaign almost entirely with his own wealth. His ads were targeted, his message was steady. And in November 2001, he won. It is fascinating to reflect on how this new chapter mirrored the traits that had defined Bloomberg's career in business. As mayor, he did not govern with speeches. He governed with spreadsheets. He built dashboards to track crime, public health, school performance, and city spending. Departments were evaluated like business units. Success was measured, not promised. Inside City Hall, he implemented a data system called CityStat, modeled after performance tracking tools from his company. Weekly meetings became performance reviews. Agency heads were expected to know their numbers and justify their outcomes. The city under Bloomberg began to feel more like a company. Bloomberg's tenure as mayor lasted 12 years, 3 terms in total. During that time, he oversaw massive changes in public health, education, urban planning, and climate policy. Smoking was banned in bars and restaurants. Bike lanes expanded across Manhattan. The city's public schools shifted toward performance-based management. And ambitious sustainability initiatives like Play NYC reframed urban development for the 21st century. Critics often accused him of being technocratic, overly centralized, or aloof. Supporters praised his pragmatism, his focus on long-term planning, and his ability to operate above partisanship. Throughout it all, Bloomberg maintained distance from his company, but never completely severed ties. He placed Bloomberg LP in a blind trust and appointed trusted lieutenants to lead it during his time in office. The company continued to grow. The terminal base expanded globally. New products were launched in law, energy, and environmental data. The culture of control remained intact. But a notable shift had occurred. With Bloomberg absent, the firm had to function without its founder. It did so successfully, but his absence also highlighted how deeply his personality had been baked into the company's rhythm. When he returned in 2014, after his 3rd mayoral term, he resumed control quietly, with no fanfare. He stepped back into leadership, not as a new force, but as a returning current. The company didn't need reinvention. It needed stewardship, and Bloomberg, ever the operator, re-engaged at full speed. By this point, he was among the wealthiest individuals in the world. But he remained pragmatic. He still worked from an open desk. He still expected performance. He still believed that problems were not political or moral, but operational. It is calming to recognize that influence does not always require reinvention. Sometimes it requires presence. Bloomberg returned not to change his company, but to realign it, to remind it of its core logic. Serve the user, refine the product, and let the system scale itself. The interplay between Bloomberg the mayor and Bloomberg the founder is rare. Few individuals have governed a city of 9 million and also managed a global technology firm. Fewer still have done so with such continuity of philosophy. Because at the core of both roles was a belief that systems can be built, optimized, and trusted to deliver, if designed well and managed with discipline. And whether that system was a city or a terminal, Bloomberg's approach remained the same. Fix inefficiencies, trust data, and keep everything moving quietly forward. If you walk into a financial office today, whether in New York, London, Hong Kong, or Frankfurt, you are likely to see the same glow. A rectangular screen with a matte black background and bright green-orange text. A keyboard with color-coded keys, quiet keystrokes, focused faces. No one speaks loudly, no one gestures, but everything is moving. This is the modern Bloomberg terminal, and it has become one of the most quietly powerful platforms in the world. Its influence is rarely discussed outside professional circles. It is not part of public tech culture. It does not shape social media or consumer behavior, but it shapes decisions, economic, financial, political, every single day. Governments use Bloomberg to monitor capital flows and inflation signals. Central banks check live bond pricing and market reactions to policy announcements. Multinational corporations model risk and analyze supply chain exposures. Traders and asset managers rely on Bloomberg for everything from split-second execution to long-horizon research. And behind all of it is a system that rarely calls attention to itself. It is fascinating to reflect on how understated this power truly is. Bloomberg LP is one of the largest private companies in America. It generates billions in annual revenue. Its client list includes nearly every major financial institution in the world. And yet, most people outside finance have never seen a terminal. That is by design. The terminal is not a consumer product. It is a professional environment, built not for pleasure, but for precision. It does not flatter the user. It equips them. And its success has never depended on hype. It has depended on habit. Once learned, the terminal becomes second nature. Once integrated, it becomes infrastructure. And for Bloomberg, that has meant a business model with extraordinary stability. The vast majority of users renew their subscriptions annually. Most firms pay for multiple terminals. The company does not sell user data. It does not run ads. Its incentives are singular. Keep the system fast, deep, and trusted. And by doing so, it has created something rare, an information product that is both ubiquitous and invisible. Bloomberg's story, at its core, is not one of disruption, but of construction. It did not destroy an industry to build something new. It quietly replaced inefficiencies. It found friction and removed it. It found silos and linked them. It found slowness and replaced it with speed. Over time, this added up, not to a trend, but to a system. A system that now supports trillions in global decisions. The company continues to evolve. New data domains are added. Environmental metrics, emerging markets, alternative assets, machine learning tools enhance analytics. The interface is slowly modernized, but the logic remains constant. serve the user by organizing the world's financial data into one continuous navigable environment. And it still feels personal. Michael Bloomberg, now in his 80s, has stepped back from day-to-day leadership, but his imprint remains. The culture, the design choices, the user-centric ethic, they all stem from his original idea. That better information, delivered faster and structured clearly, can change how people work. And from that belief, an empire was built, not through noise, but through consistency. It is calming to consider that not all innovation requires spectacle. Some of the most enduring systems are the ones that operate quietly in the background. They do not demand attention, they support it. And as you listen to this story, perhaps as you drift into sleep or simply unwind from the day, it may bring a kind of peace to know that even in the fast, high-pressure world of finance, there are systems designed with discipline, care, and quiet purpose. Bloomberg is one of them. If you enjoyed this quiet exploration, Sleeponomics offers many more stories to accompany your rest. From the rise of great companies to the evolution of global markets, we invite you to continue the journey. Feel free to subscribe, and until next time, sleep well.